What's up guys, I'm Darren Jackson. Welcome back to the channel, or welcome if you're new. And today I want to talk about avoiding risk while investing in the stock market. Investing in the stock market is one of the many ways, one of the best ways to have your money work for you. And it's so accessible, especially during this day and age where every brokerage has an app you can just download, type a couple things and sign up and just start investing. But a lot of people seem to be really nervous about investing, and I was a little skeptical myself. I think the biggest concern is, oh, I have all this money and I don't want to lose it all, or I don't have enough money, this, that, and the other. And I think it comes down to the risk that you can face. So of course I'm not a financial advisor or anything like that, and I'm still myself kind of a beginner at investing. I've been investing for about 1.5 years now, but I think I've been doing okay so far. And throughout that time, I've learned about certain risks that you can avoid and some that you just can't. So to help you guys out that are really considering investing, and honestly you're just a little scared, which is okay, I've come up with a list of 5 things that I personally follow and keep in mind every single day when I invest, and hopefully it persuades you guys to start investing or continuing to invest as well. So let's get started. So before I give you guys any suggestions that I have, you got to keep this in mind. When you invest into the stock market, you're going to deal with risk. You can't avoid risk at all. Well, you can. You can avoid risk in the stock market by, not investing in stocks. There are always opportunities to put your funds in the stock market and then lose money over time. But there are different ways to avoid those risks in the stock market. And even the 5 things that I have for you aren't the only options. These are just the most important in my opinion. So with that being said, and especially my preface, make sure when you start investing that you use money in the stock market that you are not afraid to lose. And I think the best way to do that is to create a budget. Now, I've talked about creating budgets before. There's different types of strategies to create a budget, like the 50-30-20 rule that I briefly mentioned a long time ago. But honestly guys, the easiest way you can do it is just grab a pen and paper, write down on one side of the paper all your sources of income, maybe on a monthly basis, and on your other side, all the bills you have on a monthly basis. Figure out what the difference is, and that's obviously the money you have left over. Some of that money you may use for savings accounts, and some of the money you may just use for your own pleasure. But think from that amount, how much are you willing to invest in the stock market? And hopefully that amount you're okay with putting in the stock market, which could potentially deplete over time, or more than likely grow over time as long as you make the right decisions. Besides from the stock market, on the side note, budgeting is super beneficial. I would recommend all of you do it. That's something I do every month at least. It gives you the opportunity to keep in mind where your money is coming from and where it's going every single month. And it gives you the opportunity to make certain decisions on, should I cut that out? Do I really need to pay this chiropractor every single month? I mean, I'm old, I'm always gonna have back pain. Maybe I can just stretch or do yoga. That's not my personal life. But anyway, guys, it's definitely beneficial. And in this case, it'll help you decide how much money you're able to risk putting into the stock market. So over time, you're gonna gain more knowledge as far as what to look for when investing in specific stocks or ETFs or bonds or anything like that. And there are different metrics you can look for, and that should help you decrease the risk. But as a beginner, you're gonna learn that stuff over time, and it's best to just start investing as soon as you can. So with that being said, number 2, is I recommend you guys understand the company that you're investing in before you actually invest into it. Now that sounds super generic, and it's like, okay, Darren, that makes sense. But that's not always something I did. I would focus on the wrong material. For example, I love dividend investing. I love getting that passive income just for putting my money in stocks. But there are times where I would just invest in companies because their dividend yield or the percentage that they give back in the form of dividends was super high, and I didn't pay attention to anything else, and I lost a lot of money. So the first thing you can do before you put $1 into any company is to understand their mission statement. And what I mean by mission statement is understand what the company is all about, what their history is all about, what type of products they have, and how they're contributing to society. And when you gather all that information, that should give you some idea of, is this a long-term company? Like, is this company just a one-hit wonder, or are they gonna have album after album after album over years and years and even decades? And then on top of that, you definitely want to look at the history financially of the company. The easiest startup way to do that is you can look at a certain stock on a brokerage app. So for example, let's take Apple. It's one of the most popular companies, let alone tech companies in the world. and they've been growing, since the late 80s, early 90s. You can go on certain brokerage apps such as Robinhood, and if you type in Apple, it'll give you the periods of time of growth, and you can even look at the past 5 years. And with a combination of that and their mission statement, what the company's all about, you can get more of an understanding of how they're impacted by their contributions to society. How is society responding to them? If those two things check out, then it's safe to say that that's a good company to invest in. The third thing is to diversify your portfolio. Now, over time, you're gonna gain more knowledge again about investing in certain stocks. So a lot of this you can kind of just throw under the rug after a certain period of time if you choose to. But it is safe to say that if you diversify your portfolio, you are reducing the risk and you're avoiding the risk that you may gain in the stock market. So diversifying your portfolio means a couple of things. One, you can invest in stocks from different sectors such as consumer cyclicals, technology, medicine, and energy. Or you can just invest in a bunch of different stocks, preferably a bunch of different stocks that are within different sectors. So for example, guys, my stock portfolio is filled with about 32 to 33. I think I just added another company the other day. So I have about 33 companies within my stock portfolio. Now, of course, over time, I've sold some shares of companies, so I've taken companies off the list, but that's what I've ended up with. It's honestly a combination of really great decisions and some really bad decisions at the beginning that have honestly just kind of paid off so far, but hopefully you can avoid all this. Now, my stock portfolio has different sectors within it, so it's really beneficial for me because if a couple of companies within my portfolio don't do well for whatever situation, it will minimize the effect that it has on my entire capital gains, my entire total balance that I have within the stock market. But again, I know a lot of YouTubers and friends that invest whose stock portfolios are half the size of mine, 75% the size of mine, double the size of mine. It just depends on your comfort level. But as I said at the beginning, as you grow within investing, your intelligence with stocks and what to search for will grow. So you can avoid risk in the stock market. You can learn to avoid risk in the stock market with a very small portfolio. All right, so the fourth tip that you can follow to help avoid risk while investing in the stock market is an investing strategy called dollar cost averaging. So basically what dollar cost averaging means is that you're investing into a particular stock with a little amount of money at a time rather than putting a lump sum amount into it, which could help decrease your cost basis, aka the average that you're spending on that particular stock. And it could also help decrease the amount of losses that you can get over time. And that's definitely helpful with a feature like fractional shares that most brokers have, which allows you to invest in companies with as little as $1. Now, as I said before, the main reason that you want to implement dollar cost averaging is it can help reduce the amount of losses that you may obtain from a particular company. For example, let's say that you've already budgeted and you realize you can only invest about $100 a week into your portfolio. And there's a company that you've been researching for X amount of time, and you love it, you really want to invest into it, and you finally have the money to put towards it. Really doesn't matter how much it costs, but let's just say it's $20 a share, so $100 will buy you 5. So you decide to put all $100 onto that particular stock at one time because you're feeling really good about it, and that's great. But here's a problem. So the stock market changes over periods of time, especially daily and weekly. So with that being said, individual stocks can change over time, and it's pretty hard to predict if the stock price of a company is going to increase the next day or if it's going to decrease the next day, because internal and external situations can determine that. So back to the original situation, you put $100 in a particular stock and the next day that company's stock price drops by half. So you just lost $50 in a day, which sucks. A way you could have avoided that is with dollar cost averaging. Now with dollar cost averaging, instead of putting all $100, you could have put $10 a day into that company or $25 a day for the next 4 days. And if you put $25 that day instead of the full 100 and it still dropped by 50%, then you just lost $12.50 instead of $50. So it limits your losses, and on top of that, it gives you the opportunity to buy that stock at a discounted price, which is super beneficial, especially if the stock price shoots back up to its original price and then some. And keep in mind, guys, dollar cost averaging is super subjective. It basically depends on your sources of income and how much money you have to put into the stock market. So $100 may be a lot, but at the same time, $100 may be your version of dollar cost average. So that's something you just have to figure out. Now, the last thing on my list is a type of investing style. There are different types of investing styles that you'll learn about in the future, such as swing trading, day trading, and options trading. And then there's long-term growth investing. That's the type of style that I have, along with dividend investing. What that basically means is I'm putting money in a stock portfolio that I don't plan to take out for a while. Now, of course, I buy dividend stocks and they pay me passive income, and I hope to increase that. And I may take some of that money out over time as my portfolio increases and use that money to pay bills and do stuff like that. But it's beneficial to have long-term growth investing, of course, because over time, the stock market will increase. There are a lot of situations, external situations, including one that we're in right now, where the entire stock market will take a huge hit and companies will lose a lot of opportunity and a lot of money. But if you look at the history of different index funds such as S&P 500, NASDAQ, and Dow, they always go up no matter what. Their average growth is increasing. So with that being said, if you put a certain amount of money in the stock market right now and you don't touch it, in about 5 to 10 years, it will be higher than it was back then. The economy is not just going to crash altogether, hopefully not. So that's why I promote long-term growth investing, and that by itself should definitely help reduce the risk that you're taking within the stock market, because the more time you give your money to be in the stock market, the more time you're giving your money to make more money. Those are the list of things that I do personally. Of course, there are a lot of other steps that you can take and other different advices that you can take aside from those 5 to help reduce risk in the stock market. Just remember that when you invest in stocks, you're always going to have risk. But just keep in mind of some of those things that I said, and hopefully that helps you out. But definitely leave some comments below on what you think. If there's anything you want to add, if you have any additional questions, make sure you leave a like if you happen to like this video and just enjoy hearing me talk for some weird reason. Make sure you guys check out some of these other videos as well. I really do hope they help you guys out on your investing journey as I have in mine. And I do appreciate you guys watching so much, so thank you. And until next time, take care.